Morning, everyone, and welcome to today's webinar, Finances 101. My name is Joanne Creevy, and I'm the Client Services Team Manager at Accountant Online. And I'm joined today by CEO and founder of Accountant Online, Larissa Feeney. So good morning, Larissa.
Good morning, everybody.
So Larissa is a fellow chartered accountant, and Larissa is a lead entrepreneur of Acorns program, as well as a contributor to both the Going for Growth and Ambition program. And Larissa is also chair of the Donegal County Enterprise Board, a member of the Finance Subcommittee of the Atlantic Technological University, and the president of Donegal Women in Business Network. So just a little about Accountant Online. So we are a firm of chartered and certified accountants, as well as company secretarials, supporting businesses with their compliance, payroll, secretarial, bookkeeping and tax needs. So we are an award-winning practice, most recently recognised by Xero as Partner of the Year for the third year in a row. We were also awarded Online Practice of the Year at the 2022 Irish Accountancy Awards. So this morning's webinar is ideal for new startups who have launched in the last 18 months, as it gives you an introduction to your business finances and how to understand them. So this includes a practical session to help you to learn how to read budgets, cash flow forecasts, management accounts, profit and loss accounts and balance sheets. It is important to note that the information contained in this webinar is for general information purposes only. For specific advice related to your business, you should always consult directly with an accountant. And if you do not have an accountant, we'd be happy to support you. I would like to encourage you to participate during the webinar. So please use the Q&A or chat function to ask any questions you may have for Larissa throughout the session. So over to you, Larissa.
Great, thank you, Joanne, and good morning, everybody. Okay, I'm just going to share my screen. Now, as Joanne said, this is just bear with me. Okay. So as Joanne said, this is a webinar that's designed for new business owners or non-financial business owners. So it's suitable if you have no or a very little background in finances. If you do have a background in finance, you may find it a bit basic for you. There is a small amount on this webinar this morning. We usually have higher numbers than this, so this is great for us because it does mean that you have plenty of time to ask questions. And really what happens during this webinar on a monthly basis is that the content varies according to whoever's on the call and the questions that you ask. So do feel free to ask any questions. There's no such thing as a silly question. And this, as I said, this webinar is designed for those who don't have a background in finance. So no knowledge is perfectly normal here. So just ask, and if I can't answer here, I'll certainly come back to you afterwards, and we'll do our best to answer those that we can during the hour. Okay, so that's a little bit about us, and today's format is around questions and answers. So what essentially happens is we get asked questions all the time. We deal with about 2,500 small business owners, and these are the regular questions that we continually get asked. So what we decided to do was to design a webinar that answered these questions, because we thought if we're being asked them, we're being asked them a lot, so there's probably a lot of business owners out there who have the same questions. So this is what I'm going to go through today. Essentially, the differences between CRO and revenue, a little bit about bookkeeping, a little bit about tax, a little bit about VAT, a bit about how you pay yourself, and then going into the financial statements, but just cash flows, management accounts, statutory financial statements. As I said, just interrupt me at any time and use the Q&A function or the chat function. Put anything you need to ask in there, and then Joanne will ask me as we move through. Okay, so number one is compliance with Companies Registration Office, which is CRO and revenue. So essentially, the question here is always around, what do I need to do as a business owner in order to stay compliant? And the answer to that depends on your structure. And I know from those that have registered for the webinar that there is some of you are sole traders and some of you are limited companies. And really, the structure that you are depends on what you have to do to keep yourself compliant. So to start with the simplest structure, that's a sole trader. And by the way, before I even start, we do have, if you have questions on this topic, that we do have a webinar that goes into this in much more detail. Joanne, you might pop up the date of the next startup webinar. So the
Yes.
startup webinar, that will help answer the question of what structure is suitable to you. And Tamar hosts that revenue on a monthly basis, and Joanne's going to pop that in the chat.
Yeah, so our next one is on the 10th of January, and I'll pop in the registration link there for anyone that would like to register for that.
Super. Okay, so if you are a sole trader, you have to register with revenue commissioners as a sole trader. Your only really interaction with the company's registration office would be if you are trading under a name that's not your own. So if you are trading under a business name, you should register that business name with CRO. It only costs €20, and that's all you have to do. There is no compliance requirements after that. As a sole trader, you just have to register for tax, for income tax with revenue commissioners. You also have to register for VAT and for PAYE if those taxes apply to your businesses. But at its most simplest structure, it is just registration for income tax. So that means that you have one set of accounts and one tax return to do on an annual basis. That's usually due in mid-November for the previous tax year. So the tax year in Ireland runs from the 1st of January to the 31st of December, so the calendar year. And then as a sole trader, you file your tax return the following November for that year. And that's your only compliance that's necessary as a sole trader. Now, if you're a limited company, it's a little bit of a step up. It's a little bit more complicated or complex, I suppose. There's about 200,000 limited companies in the state, in Ireland, and the same rules apply to them all. So no matter what the size of company you are, the rules will apply to you that apply to any other company. So they can get quite complex. So the right thing to do is to seek advice. So if you are questioning whether a limited company structure is right for you, do attend that webinar at the start of January, and that will help answer some questions you have around your obligations as a director of a limited company, as a company secretary of a limited company. If you have decided to go ahead and you've already set up your limited company, you have to first of all register with the company's registration office as a limited company. And then there's an annual return that has to be filed with CRO every year. And that's a very important deadline you should have on your calendar. So if you are a director of a limited company and right now you don't know what that date is, find out and put that in your calendar for next year. It's very important that you don't miss that deadline. Your company secretary does have responsibility for making sure those returns are right. But as always, you as director, you can't step away from that responsibility as well. So make sure you know when that date is. Your annual return and your accounts get filed directly with the company's registration office. And those accounts are a matter of public record. So this is a big difference between sole trader and a limited company. As a limited company, your accounts are public. Now they are abridged accounts, so they're a summary version of accounts, but they are a matter of public record, where anybody can log in and purchase your accounts for, I think it's €2.50. You also have to register with revenue commissioners, the same as a sole trader, except you register for corporation tax and not income tax. You will register yourself as a director for income tax, but you register the company for corporation tax. So not only do you have to keep compliant with the revenue commissioners in that you file a tax return with them once a year, the company also has to maintain compliance with the CRO, the company's registration office. And the one thing to be aware is that return that you file with the company's registration office, if you don't file that, there can be severe implications for the company. At its worst, CRO will strike the company off. And that means that if you still need to trade, you have to jump through a lot of hoops to get that company reinstated again. And really, as a business owner, you don't want to do that. So the advice I would give is make sure you know what that deadline is, and make sure you know. Now, usually your accountant or your company secretary, as I said, will file it for you, but you should be aware of when it is so that you can expect it. Okay, so on to bookkeeping and understanding the numbers. Now, this webinar, as I said, is for non-financial business owners. The aim of the webinar is not to have you guys fully qualified bookkeepers or accountants by the end of the hour, of course. But all it is to hopefully give you a little bit of knowledge that will help you ask the right questions of those, either of yourself, if you're doing the bookkeeping yourself, or of whoever's doing the bookkeeping for you, or of your accountants. So it's just really to, I suppose, give you some more knowledge or arm you with some tools to help you to run your business better. Now, bookkeeping is the most important part of your finance function. It is the foundation of your business. If your bookkeeping is incorrect, everything else is wrong. So you can't have a set of accounts that's correct. You can't have a tax return that's correct. You can't make sound financial decisions if your basic bookkeeping, the foundations are unsound. And that's, I suppose, the first thing I would say, to make sure that whoever is doing your bookkeeping knows what they're doing, whether it's you, whether it's somebody else that you're asking to do for you, or you're outsourcing it completely. Whoever you get to do it, that they're suitably qualified and experienced. It is one of those areas that businesses do tend to try to do themselves in the early days. Some business owners are equipped and fully able to do that, and some are not. So if you fall into the latter category and you don't have the skills to do bookkeeping, then don't do it. Outsource it. It's much more cost effective to get somebody else to do it and allow you to concentrate on those areas that you are good at to help you grow your business. Now, first of all, what is bookkeeping? So bookkeeping is the basic recording of transactions in your business. So it is how we record your money in and money out. It is the recording of things like purchase invoices, your sales invoices, your bank transactions. And all of these transactions come together to form your set of accounts at the end of the year. And really your accounts, as I just described in the first slide, you need your accounts for compliance purposes. You need them to make sure that your tax return is right. But that's just compliance. You also need your accounts to run your business. You need your bookkeeping to be correct so that you can get your budgets, get your cash flows, get your management accounts, to give you sound information to allow you to make the correct decisions on an ongoing basis. So that's essentially what we need bookkeeping for. And sometimes it's tempting to do bookkeeping, at the end of the year sometimes, or, every few months. But in reality, you should be doing the bookkeeping, or your business should have bookkeeping done at the very minimum on a monthly basis, ideally on a weekly basis or every couple of weeks, because that allows you to make sound decisions, and that allows you to see real-time information that will help you run your business. Okay, so how do you keep your records? So as I said, bookkeeping is recording of all transactions, and that comes from various sources. So in order to produce sound financial information and correct financial information, we have to take those records from places like bank statements, from maybe cash records if you're in a cash business, from perhaps from purchase invoices and sales invoices, and maybe things like creditor statements and loan accounts, and there's various different sources of information. So revenue commissioners are in charge of, making sure that they monitor how we keep our records. And what they say is that you have a responsibility as a business owner to keep adequate books and records. So that word adequate is what they use to determine if your books and records are maintained correctly. And adequate means that any reasonable person can find their way around your records. So that's it at its basic level. So they don't say that you have to have software. They don't say that you have to use a spreadsheet. They don't say they leave it very much up to the business because of course every business is different size, different stage, different industry. So they leave it very much up to the business. What they do say is that any reasonable person who goes to look at your accounts and goes to look at your records, that they will be able to understand what you've done, and they'll be able to follow the transactions from the beginning to the end. Can you hear me, Joanne? If for whatever reason they come in to look at your business and they decide that your books and records are not adequate, then they'll take action to determine what needs to be done in order to correct that situation. So from the very beginning, you should maintain your books and records correctly. You might start, for example, keeping your books and records in a spreadsheet or even on a cash book, and then you may transition to online software or enterprise type software as your business grows. You have to decide as a business owner what's appropriate for you. what's appropriate for your business, and then change it accordingly. And always remember that even if you do outsource bookkeeping or the company secretary role or your accounts or your tax, no matter what you do, no matter what you outsource or whether you do it yourself or you get somebody to do it for you, ultimately it's your responsibility. So you can outsource the task, but you can't outsource the responsibility. Revenue commissioners will always come to you as the director or the owner of a sole trader business to answer questions that they have. Now, you can refer them to your paid advisors, absolutely, but ultimately it comes down to you having the responsibility to maintain adequate books and records. So if you find yourself in a situation where you're not too sure and you're not 100% confident in your ability, again, if you make sure that you outsource it to adequately qualified, insured individuals or professionals that can do the job for you. Okay, so what books and records should you keep? What should a sales invoice look like? And how long should you keep records for? So you need to keep all of your books and records, is the easiest way to describe that. You have to keep everything. If you think about your bank statement, every transaction that comes in and out of your bank account, you need to make sure that you have backup for everything. That's the easiest way to describe it. Likewise, if you are in a cash business, and do try to minimize cash as much as possible. It's not ideal. It is very difficult to get it wrong. And cash businesses are notoriously hard to produce correct figures for. It's just harder probably because it's a little bit messier. It's much easier if everything's in the bank, much easier for everybody to find the transactions and to reconcile the transactions. You have to keep your records for 6 years. Now, how you keep them, where you keep them is up to you. Most businesses will now keep them in some type of an online file share or file storage system. If you have online software, something like Xero or Sage, you can attach the invoice or the receipt to the transaction on the system. That's a really easy way to make sure everything's kept together. But likewise, if you're still keeping manual records, that's absolutely fine too. You have to keep them for 6 years. Revenue commissioners in an audit will generally go back a couple of years in an audit. They can go back further if they find something that they think they need to investigate. But certainly initially they'll go back a couple of years and make sure that everything is as it should be. Okay, the next slide then gives you an idea of what a sales invoice should look like. Now, so this is actually one of ours, and it's for any of you that are in a B2B business. If you're in a B2B business, you usually have to produce an invoice. Revenue commissioners can fine you, by the way, if you do not have an invoice for something that you should have an invoice for. And if memory serves me right, it's about €1,500 for every instance where there's a missing sales invoice. So it is very important to get this right. If you use software, the software will do this for you. You don't have to worry about it. So again, going back to Xero or Sage, or there's plenty of software on the market. There's also a few invoice only software providers that will just produce the sales invoice for you. So you don't have to do this manually. You don't have, and if you do use software, then as I said, all of this is taken care of for you. You don't have to worry about it. But just to make you aware that any invoice that you have should be very clear in who you're invoicing to, what you're invoicing for, and a breakdown of the VAT rate, and also it should have the tax reference number, your VAT reference number, and also the what's called the tax point, which is the date that the invoice is issued on. So just bear that in mind whenever you're sending an invoice out, that there is an obligation again on you as a business owner to make sure that the sales invoice is correct.
And Larissa, I suppose for some new businesses, they would ask around that VAT aspect of an invoice. So that wouldn't apply if you're not VAT registered, just to be clear on that.
Yes, exactly. Thank you, Joanne. If you are not VAT registered, so if you're a business that's trading under the threshold, or perhaps you are exempt from VAT for some reason, then you do not have to put your VAT reference number on it, your VAT number on it. You don't have one, and you should not charge VAT or reference VAT anywhere on the invoice. Thanks, Joanne, for that reminder.
And see, for the B2C invoices, you mentioned there that there could be a possible fine of 1,500 if there isn't an invoice for a sale. Would that still apply for B2C?
No. So what happens in B2C is, so B2C, for those of you on the call. B2C is a business to consumer business as opposed to a B2B, which is a business to business. If you are in a business to consumer business, a consumer doesn't have an expectation of having a VAT invoice for every transaction, but they should get a receipt. Now, you'll all be very common with being asked if you wish to have a receipt whenever you're at a till. Consumer all can say no if they wish. From the business's perspective, you should have a record of every transaction. You're not going to have a sales invoice like this for every transaction, but you will have a record or a report that you can see individually what the transactions are and collectively per day, per week, per month from a reporting perspective. So that's what the requirement there is, Joanne. And again, if you're selling online to consumers, the software out there will do this for you. So it's not something you have to worry about. If you're using something like WooCommerce or one of those, you'll have the report when you need it. If you're an offline seller, like if you're in a shop or retail or bar, your report, your till report will have to show that at the end of every day, how much has been taken in, and even to be able to go deeper on that in terms of how many of each product have been sold.
That's great, Larissa. Thank you.
Okay. Okay, so minimizing your tax liability. Now, as I said at the start of the webinar, there's two structures that we're talking about today, sole trader and limited company. So talking for a moment, well, first of all, generally speaking, what I should say is that if your bookkeeping is correct, so if you have maintained your books and records correctly, then that's the easiest and simplest way to minimize your tax liability. We get asked all the time, how can I get my tax down, and how do I keep my tax low? That's the most basic way of doing it, is making sure your bookkeeping is correct. You'd be really surprised how many businesses don't record all of their transactions through the year and then miss that opportunity to lower their tax bill just because they've forgotten how much they've spent, especially if you have a cash business. Because if you have a cash business, it's very easy not to remember what you're spending. So again, but keep cash to a minimum, lodge everything into the bank. I guarantee you, even if you're paying bank fees to lodge cash into the bank, you're saving more on tax at the end of the year. So if your bookkeeping is correct, first of all, that's the best way to minimize your tax liability. Pay everything for the business out of the business account. Whether you're a sole trader or a limited company, make sure all business transactions go through your business account. If you're a sole trader and you're just after setting up, you should have a separate bank account for your business. Limited companies are required to have a separate bank account, but sole traders, we find, sometimes are a little bit reluctant to set up a separate bank account because there is costs involved in doing that. And I understand that. However, it's very important to keep your business transactions separate to your personal transactions, and there's loads of reasons why you would want to do that. But I mean, at a basic level, it sets you up for success going forward, because it means that you're separating out the business spend versus the personal spend, and you're keeping all of your personal transactions in one place. And you'll get into the habit early on of transferring a set amount from your sole trader business account to your personal account. So that means that you can pay yourself a salary, and I'll talk a little bit about this later, but pay yourself a payment, not a salary as a sole trader, into your personal account. If you pay for all of your business transactions through your business account, it means that whoever's doing your accounts, it's all captured in one place. It's very easy for them to see that. If you pay some business expenses out of your personal account, again, it's harder for the accountant or the bookkeeper to see that. And there's no need for them to see your personal transactions. So keep everything in the business account. If you find as a sole trader that the business account, there's not enough money in it to pay business expenses, transfer money in from your personal account and then pay it back whenever the business can afford to pay it back. Don't pay it out of your personal account and think I'll do the changeover later. It's easier if you put a lump sum in, even if it's a small amount of money, and pay that back when the business can afford it.
Larissa,
So
can
keep
I
it.
ask, sorry, because that's something that we get asked quite often, and how would you record that transaction if you were sort of transferring from your personal account into your business bank account to sort of keep cash flow going? What is the name, or how would that be sort of marked in your bookkeeping?
Yeah, I've seen it done a few different ways. I always think the clearer it is, the better. So
Yeah.
loan to business is a great way.
Yeah.
And then it's very, very clear that you have an expectation of getting that back. That's the way I would describe it. And then your bookkeeper can keep a record of the loan to business transactions, and then you can say, okay, I'm owed X amount back from the business. Yeah.
Just as clear as possible then.
As clear as
yeah.
possible. Absolutely. Yeah. Yeah.
Thank you.
Now, if you're a limited company, so the same applies. You will have a separate limited company bank account. You are required to do that. The rules are a bit stricter around, money coming over and back. So you have to be very careful. Again, keep everything separate. And this is really important as a limited company. Keep everything completely separate. You'll pay yourself a salary and you'll pay your business expenses out of the business account only. If you have, again, the situation where the business account is running low, you can loan the business money and it will pay you back whenever it has the cash flow to do so. As a limited company director, you do have the option to claim mileage and subsistence. Sole traders don't have the same freedom, I suppose, or don't have the same ability to claim in the same way. So if you're a director of a limited company, you should be claiming mileage from your business. You should be claiming subsistence. And if you go into the revenue.ie website and even Google revenue subsistence rates or revenue mileage rates, it's very clear how much you can claim. And every director, most directors that I come across do have some element of travel, business travel in their personal car and should be claiming for that through their business bank account or through their business. If you're a sole trader and if you are traveling for work, then do take advice on the best way to claim that for your circumstances. You might find that it might be more beneficial to pay all of your motor expenses through the business account if your business mileage is high. But if your business mileage is low, it may not be a good idea to claim everything through the business account. It's very specific to your circumstances as a sole trader. It's not a black and white, unfortunately. So do take advice. But if you are a director of a limited company, as I said, it's a lot easier to claim. Essentially, a director of a limited company is treated just like an employee. So if an employee is entitled to mileage, then a director will also be entitled to mileage under the same rules. So do a little bit of investigation if that's you, and do claim for it because it is tax deductible. And not only is it tax deductible in the company, but it's tax free for you. So as a limited company director, you're able to claim mileage tax free because essentially it's a reimbursement of expenses. But the mileage rates in the Republic of Ireland are quite reasonable, I always feel. And I always feel that it's an area that directors should claim more because, well, should claim what they're entitled to. But invariably, it's most directors underclaim because it's a little bit of an admin burden. You do have to make a mileage claim and submit it to your company on a monthly basis. Now, other areas of minimizing tax liabilities around, for example, well, as I already said, making sure there's obvious expenses that are tax deductible that everybody knows. Your materials, your wages, your insurance, and nobody ever has any difficulty with that. The questions we always get asked, or the areas we always get asked about, are like motor expenses that I've already described, or perhaps like clothing. Can I claim for clothes? Can I claim for suits and ties and things like that? So you can only claim for what's called protective clothing. So, high vis, overalls, things like that. You can claim for advertising those. So, I mean, if something is advertising your business, that's allowed to be claimed for. So do bear that in mind. The other area we get asked a lot about is around your home, renting out or using your home for your business. In other words, working from home. And again, it's a little bit of a difficult area to talk about because everybody's circumstances are so different. But essentially, if you are a limited company, and if you are a sole trader actually, and if you're working from home, we get asked, can the business pay me rent because the business is taking up part of my home? Now, it's usually not a good idea, and I always generalize in these circumstances, but generally speaking, it's not a good idea. And the reason is because it's taxes income on you as well. So if the business pays you a rent, then you have to declare that money as income, and you'll more than likely be taxed at the higher rate. So it's generally not a good idea. And also you have to consider commercial rates if commercial rates come into it as well. Plus you have to consider the potential loss of what's called your principal private residence relief, which is relief from capital gains tax if you were to sell your home. So there's a few things to consider there and bear in mind if that's something that you have been contemplating recently.
Larissa, just a wee question just before we move on, just regarding the director's loan. So they're asking, is the proof of the transaction to a business account sufficient, or do we need a written confirmation?
Proof is fine. So I suppose the question is, if you have money going from the personal account to the business account, and you can see money coming out of one account and going into the other account, that's absolutely sufficient. You don't have to do any more than that. Now, at the end of the year, whenever your accountant does up, or even, through the year, if you have somebody doing management accounts for you, that figure will always be there as the money that's owed to you. And in some cases, you may owe the business money, but you don't really want to get into that situation. And I would advise against that. But yes, it's totted up and then the balance at the end of the year.
Great. Thank you, Larissa.
Okay. Now, if you are in a situation where your business is growing, or you're perhaps a little bit further on in your business than the first couple of months, or even the first couple of years, the major way to save tax through your business is through paying into a pension. So pension installments are very tax efficient in Ireland, especially if you're a limited company. If you're a sole trader, and if you're paying large amounts into your pension, you probably should be a limited company at that point. There's a trigger point really for moving from sole trader to a limited company, and large pension payments. You'd probably be in a limited company structure if you were in that position. If you were a limited company, and you can take advice and again on this, but there are generous allowances for directors that make payments into pension contributions. That may or may not be the right decision or the right path for your business right now. Again, it depends on where your business is at in its journey. So say, for example, you may have cash in the bank, but you may need that cash for future growth plans or whatever, in which case you don't want to tie it into a pension for the long term. But if you do have excess cash, that is a great way to save tax. It's tax deductible on the company. But it also means, of course, that you're getting money out. Essentially tax-free when you withdraw it, although, of course, you pay tax whenever you draw it down in the future. But you do have more freedom at that point in terms of what rate you pay tax on.
Larissa, another wee question here about expenses. So can any portion of apartment annual management fees be claimed as an expense if your business is run from your apartment?
Okay, so the same rules would apply to management fees as would apply to rent. So that's just something to bear in mind. It would be seen as a rent that the business is paying. So tax deductible on the business, yes, taxable on you as the owner of the property, or the major tenant of the property. So generally speaking, it's not a good idea. I would ask you to seek advice on it though. In the cases that I've seen over the years, I've never found it beneficial for a business to pay rent from a tax perspective, of course, because the individual, i.e. us as directors or business owners, we're still paying tax at the same rate. So it's not beneficial, considering the potential consequences around loss of PPR relief for capital gains tax, and the potential issue around commercial rates, which isn't a major potential issue, but it is there at the same time. So whenever you consider that, I always feel I don't see a case for it.
Yeah, no benefit really to it. Just another wee question, just maybe if you don't mind clarifying, someone working from home, they're a limited company, and can electric and heating costs be claimed? I know there's two different ways you can do that, if you don't mind just sort of explaining that in a little bit more detail.
Sure, yeah. So you're absolutely right. There's two different ways you can do that. So you are allowed to claim expenses, and thank you for asking the question, because I didn't clarify that. You are allowed to claim expenses for anything that you're out of pocket in terms of working from home. So if you are working from home, the business can pay for the utilities. The business portion of the utilities, that's fine. That's an expense. And as Joanne said, there's two different ways of doing it. You can either claim the expenses. So let's say, for ease of calculation, you have a property with 4 rooms. You work in one of them, and let's say you work 24 hours a day. Then you can claim a quarter of your utilities, and that's absolutely fine. Where it gets very difficult is because obviously we don't work 24 hours a day. Some of us don't have a dedicated room. Some of us have other people that we live with, and so on and so on. So it can be quite difficult, or some business owners find it quite difficult to have to calculate a reasonable estimate of what the business percentage use of those utility bills are. But if you're happy with your calculation, and remember, by the way, this is a self-assessment system. So you can claim it, whatever you deem is reasonable. And then it's only ever checked if somebody, if revenue audits you and ask you for your calculation. But you need to be able to produce it. Otherwise, they will fine you and penalize you. So that's one method of doing it. And then the other method is just claiming the flat rate of, I think I've forgotten, it's either €3 a day or 3.25 a day.
320, I think it is.
3.20. Okay, thanks, Joanne. Thank you. So 3.20 a day for the days that you're working from home, and you can claim that through your tax return, and there's no questions asked. So you do not have to produce income for that. You don't have to produce a calculation, and that might be a reasonable estimate for the work you do from home, and it may not. It depends, which is why revenue allow the two methods.
That's great. Thank you, Larissa. I hope that has answered your question there as well. Thank you.
Thank you. Okay, so moving on to value added tax, or VAT. So VAT is a tax that we pay in Ireland and indeed in Europe on the purchase of goods and services. Now, as businesses, VAT should never be a cost. It should not be a cost to you or your business. Essentially, as a business, you charge VAT on your goods or services. You pay VAT on anything that you buy in. And the idea is that when a customer pays you, there's an element of that payment that is VAT. And you hold on to that in your business bank account, and then you pass that on to revenue by the due date. So in theory, there's no cost to you as a business to register for VAT, right? You're just acting as a collection agent from the consumer over to revenue. That's the theory. In reality, however, it's different. If you're in a B2B business, so business to business, and you were selling goods and services direct to other businesses, there is no issue around VAT. And indeed, most B2B would register for VAT practically straight away. You don't have to register for VAT until you cross the threshold. So that's 75,000 for goods and 37,500 for services. And that's on a rolling 12-month basis. So unless you're over that turnover threshold or revenue threshold and an annual 12 months, you don't have to register for VAT. If you're in a B2B business, you may decide to register for VAT early, especially because if you think that you're going to cross the threshold quite soon. And sometimes it's easier because if you register mid-business, it can be a bit of an admin, exercise, I suppose, to let everybody know that you're going to register and all that kind of stuff. So if you're in a B2B business, and regardless of whether you're a sole trader or a limited company, by the way, the same rules apply, it usually makes sense to register for VAT. The only cost to you will be the admin cost of getting the VAT return calculated and completed. And there is sometimes a bit of a cash flow headache. Now, as I said, there shouldn't be, because we are just acting as a cash flow, as a collection agent for revenue. But in reality, the demands of business sometimes take over. And sometimes it can be a cash flow headache. VAT is due every 2 months. You might collect money from a customer on the 1st of January, and you're not due to pay that VAT over to revenue until the 23rd of March. So you're holding that cash. And business owners are human, and sometimes demands take over, and you might find that you have to pay something using that money. What I advise business owners to do is to have a separate VAT account or a separate tax account that will allow you to put that money aside, so that you're not worrying about it when it comes to VAT return time. And that's a very easy way to get the money out of the trading account, because then even you're looking at your cash flow, you're looking at your bank balance, and you're not worried about VAT. So do have a separate bank account, a separate VAT account set up for that purpose. Now, if you're in a B2C business, so business to consumer, it is a bigger question around VAT registration. As I said, VAT shouldn't be a cost to you, but if you're in a consumer business, then you're likely selling your product or service at a price that the market currently demands. So if you are competing, if you have to register for VAT because you're crossing the threshold, you could be competing against businesses that are not VAT registered, and therefore they may be able to make a bigger margin or a bigger profit than you do, simply because of the fact that you're bigger than them. So it is something that you have to consider. And I always say to B2C businesses to take advice around VAT registration so that you can understand your margins, because it's not as easy as the B2B. In B2B, you just simply add in the VAT on. It's no big deal. Your customer can claim it back. So it's no cost. But in a B2C business, your customer cannot claim back the VAT, and therefore it is a consideration. So sometimes you can add the VAT on depending on the market and who you're selling into and what you're selling, and sometimes you can't. And it's those situations where you can't add the VAT on, you have to maintain your selling price at the same level. Automatically, your margin's been cut. And is that good for your business? And can your business grow and scale to a level that makes that worthwhile for you? So that's my advice there. Okay, moving on to the next slide. Which is how to pay yourself from your business salary or dividends. So again, if you're a sole trader, it's not as easy as paying yourself a salary. Sole trader, you are taxed on the profits that you make. So regardless of what profits your business makes, you're taxed on that. Sorry, regardless of what you spend, you're taxed on the profits your business makes. So if your business makes 20,000 in profits over the year, your drawings is what they're called as a sole trader. Your drawings is included in that 20,000 and you're taxed on the entirety of the 20,000. So although you should get into the habit of making a payment to yourself from your business bank account to your personal bank account on a weekly or every 2 weeks or monthly basis, you're still taxed on how much the business makes in its entirety. So it's something to bear in mind that whenever you go to your accountant at the end of the year, and do, by the way, guys, try to get your accounts done early in the year if you can. It does make more sense. It does give you more time to prepare for any tax bill. So if you're going to your accountant and your accountant says, your profit is 50,000 and you're thinking, goodness, where's that 50,000 gone? You have probably spent it yourself and you've been taxed on that total amount as a sole trader. As a limited company, you would take a salary from the business. So you, as a director of a limited company, you are automatically an employee, and you will draw a salary from the business on a weekly or fortnightly or monthly basis, and that will get returned to revenue with your other employees. So you'll get taxed as an employee, which is great for directors because it means you're on top of your tax and you don't have to worry about it. Then your company gets taxed on profits less your salary. So your salary is taken out of the company profits and your company is taxed on the balance. And this is why we always hear, if you listen to the media, they talk about the 12.5% corporation tax rate. And that's because limited companies pay tax at 12.5%. Directors of limited companies we still pay tax at personal rates. So that doesn't change. So we pay tax at the same rate as a sole trader would pay tax. There's no difference between the two. However, the limited companies only pay tax on profits after your salary, whereas sole traders pay tax on the entirety of their profit. And this is why it's important, and your accountant will advise you, as your sole trader business grows, there will become a point where it makes more sense to be a limited company and not a sole trader. Now, that point varies from individual to individual. It's not black and white. But essentially, if your business starts making more money than what you personally require in your lifestyle, whatever that lifestyle is, then it probably makes more sense for you to be a limited company. Sole traders have to pay their tax every year. Limited company directors pay their tax every month through the PAYE system, and the limited company itself pays its tax every year. And to answer the question on the slide, if you're an Irish resident director of an Irish resident company, you will pay yourself a salary and not dividends. Dividends are not tax effective at all. In actual fact, you end up paying tax twice on dividends if you were an Irish resident director of an Irish company. So for the vast majority of cases, it makes more sense to pay yourself a salary and not dividends. Now, there is exceptions, of course, to every rule, and if you find, you may have to seek advice around that, especially if you have investors in your business. If you have other shareholders in your business and you want to vote a dividend, then you have no choice. You have to vote yourself a dividend if you are also a shareholder.
And Larissa, can you pay yourself both a salary and a dividend?
You can, and this sometimes happens, Joanne. Say, for example, if you have a full-time working director in a company,
Mhm.
so let's say, for argument's sake, you have two shareholders,
Yeah.
one of which works full-time in the company and one doesn't.
Mhm.
So the individual that works full-time in the company is entitled to a salary, and they get a salary, and they're paid monthly. The individual who does not work full-time can't get a salary because the salary is obviously exchanged for work,
Yeah.
and they're not working in the business, so they'll generally get a dividend. But you can't have half the shareholders getting a dividend and
Yeah.
the other half not. You have to vote equal dividends across the
Okay.
two, assuming that they have the same share class with the same rights. So in that case, you would have one director getting a salary and a dividend, and the other one just getting a dividend.
Great. Just someone asked the question, but you sort of confirmed that just slightly after he asked the question. Just that, does a director salary go through PAYE? And to confirm it does.
Yes, it does. A director is treated like an employee, without the benefit of having the requirement to get minimum wage, unfortunately. But
Yeah.
other than that, directors are employees, and yes, they would go through the payroll system. And it's important, going back to what I said earlier, it's very important to make sure that you do that. I mean, I haven't talked about PRSI, the social
Mm.
contribution, but as you know, as business owners, you should maintain your social contribution every year. As a director, if you're getting a salary from your company, that means you're paying your PRSI contribution along with your tax. Sometimes the company can't afford to pay you a salary. And I always advise, if possible, for the company to pay you a salary and then for you to put it back in if you need to. But it's important to maintain that contribution to PRSI through your working life in order to maximize your entitlement to pension and various different benefits that's on offer from the Irish state. Likewise, as a sole trader, now I have seen several cases over the years where tax bills are too low to trigger a PRSI contribution as a sole trader. And I always feel that's dangerous. It's okay for a year or two. Sometimes that happens, especially whenever you're in startup mode and there's literally no money. But really maintaining a PRSI contribution is the minimum that you should be doing as a business owner to help yourself in the future, because the years go by so fast, and you don't want the gap to be significant and into it majorly affect entitlement to pension.
Larissa, I suppose some of our clients would come on board and set up a limited company, but they may have a full-time job. In that scenario, they can choose not to pay themselves a salary from the company. Is that advised there in that kind of circumstances?
Yeah, so it's a great question. It really depends on the circumstances.
Mm.
What we see is that if you have an individual who has a full-time role with an employer and is earning a reasonable salary that allows them to pay all of their living expenses, so they may not have a requirement for the money that they make in their spare job or their little business on the side.
Yeah.
If you have a little business on the side, then sometimes it can be beneficial for it to be a limited company, especially if you don't need the money. If you don't need the money, then the money doesn't have to be drawn down as salary. The limited company pays 12.5% as opposed to 50% as an individual. That makes sense. If you do need the money though, and if you do draw it down, it may not be a good idea. So definitely have to take advice if that's you.
Thank you.
Okay, so moving on to the financial statements now. We talked about a little bit about the requirements at the start of the hour around your compliance requirements for revenue and company's registration office, depending on the structure of your business. And that's what you absolutely have to do, right? As a business owner, those are your requirements. However, in order for you to run your business correctly, you should be looking at your numbers a lot more frequently than once a year. I've already mentioned the importance of bookkeeping and the importance of regular bookkeeping and making sure that either you as a business owner are allocating a couple of hours every week or maybe every couple of weeks to your own numbers, but also if you're outsourcing it, that you're doing that regularly. And that regular bookkeeping and that strong foundation in terms of the finance functions allow you to look at the numbers in real time and understand what's happening. And this is where budgets and cash flow forecasts come in. And they're all fancy words, but really what I want to do today is simplify it as much as possible to the stage that your business is at. If any of you have gone for funding, for debt funding in terms of bank loans or equity funding from angel or VCs or whatnot, you'll be used to being asked for this information. You know, they want to see 3 years budgets, they want to see 3-year cash flow forecasts. And small businesses, unless they're asked for it, generally they won't do it. But I would advise all small businesses to start from the very beginning of your business and look at your budgets and cash flow forecasts. And again, it sounds very fancy, but it's actually very simple. Because from a budget perspective, all you're doing is looking forward. In many ways, you're estimating or guesstimating what's going to happen. But essentially, if we're sitting here at almost the start of December and you're going to look forward over Christmas, depending on your business, you may be very busy, you may be very quiet, and out into January. If you can put down on a spreadsheet or a book or something what you think you're going to take in terms of revenue and what you think you're going to pay out in terms of expenses. And that's essentially what a budget and a cash flow is. It's just an estimate of what's going to happen over the coming months. But by doing that, you're setting yourself goals and you're being very clear on what you expect to achieve. So then once you revisit it, whenever you get to the end of the period and you revisit it, you're essentially doing management accounts, because what you're doing is you're comparing what you thought was going to happen with what actually happened. It doesn't have to be complicated. As your business grows, you know, there's various different softwares, of course, that will do this for you. But for the purposes of the stage that your business is at, you're all in startup, you know, in the first few years of your business, it doesn't have to be very complicated. You just have to make sure that you know what's happening, that you know, that you think, you know, that you've mapped out what you think will happen over the next 3 or 6 months. And then crucially, that you compare what has happened to what you thought would happen, because that allows you to question yourself and that allows you to understand, okay, what's happening out in the market. In other words, you can see what's coming. It helps you to understand what's coming, because it's very hard to sit down with your accountant every year and look back. Because, you know, as I said, compliance requires us to do that, and that's fine, we have to do it. Really, as business owners, we need to be looking in the here and now and looking forward, and not looking back. And management accounts, cash flows, and budgets allow us to do that. They allow us to look forward and to understand what's happening. And then you can spot trends. And then you can see things like, okay, I thought I was going to bring in €1,000 this month. I brought in €1,200. What happened? You know, that's great. You know, why was I so busy, etc., etc. It just allows you to ask those questions. And then we're on to statutory financial statements. So I've talked a little bit about these already. These are what you have to do. You'll sit down with your accountant on an annual basis, whether you're a sole trader or a limited company. You will sit down with your accountant and they will prepare your accounts for the previous financial year. Now, I have these last because they're the least important as far as I'm concerned. I mean, the accountant will produce a lovely, beautiful looking sets of accounts for you and you need to do them. You have to do them to be compliant, but actually they're really of no use to you. Apart from telling you what your tax bill is going to be, they're of no use to you. They're in the past. And really the accountant should not be telling you anything that you don't know already. You're the business owner. So if you've been monitoring your numbers through the year, you'll have a fair idea of what your profit's going to be or what your loss is going to be. Your accountant shouldn't tell you anything that's a surprise to you. You know, they have to do things in certain ways, and legislation requires us to do that, and we have to present the accounts in a certain way, and again, legislation requires us to do that. But from a business perspective, from a business owner perspective, they're not any use to you. So although you have to do it, budgets, cash flows, management accounts, much more important. The only thing I would say about statutory financial statements is to get them done as soon as you can, the beginning of your tax year. So most businesses in Ireland would have a tax year, again, 1st December to the 31st of December, or 1st of January to the 31st of December. So if that's you, that means you're coming up to the end of your tax year now at the end of December. So get your accounts done as early as you can in the new year. That means that you will have time to prepare if you do have a tax bill. And again, a lot of businesses have a separate bank account for tax, so you can put money into that to prepare for it. But there's nothing worse than having your accounts done in September, October, and then been given a tax bill that you weren't prepared for, that you didn't know was coming. That makes it very difficult to plan. And again, going back to what I said earlier, it does mean that sometimes you have to use funds that should be allocated elsewhere to pay tax, and you don't want to be in that position. So do try and get your accounts done early in the year. It benefits everybody. You know, your accountant also has more time earlier in the year, of course, as well than ever. You know, the autumn is the busiest time for accountants. So if you want to get, I suppose, more dedicated time from that service, it's much easier, it's much better to use an off-peak period than a peak period. Okay, and finally then, what does your accountant do and what can you expect from your accountant? So if you are new in business, you might be in a position where you are trying to find what the best professional advisor is for you. The accountant will do what you ask them to, is probably the best way to describe it. Most businesses will come to us and say, you know, what do I need to do to remain compliant? And that, as you know from the last hour, is your basic bookkeeping, your VAT, your payroll, and your financial accounts, your statutory accounts. That's what you have to do. Very few businesses ask us, what should I do? And really, if you're asking your accountant, what should you do, you might get a different answer. You know, it would be around more regular advice. It would be around more regular meetings, almost like a partnership in your business. And that's essentially what you're looking for, somebody to help you in real time with the numbers, with your budgets, with your cash flows. It's really important for you to be very clear with your accountant and communicate clearly what it is that you require. It's also important to continue to do that on an ongoing basis because your business needs change as your business evolves, and keep communication to your accountant that that's happening, because that sometimes can be difficult if expectations change a little bit. If you're looking for an accountant, I always advise against asking friends and family, actually, because it is a professional relationship. You're much better asking acquaintances who are in similar size businesses as yours, or perhaps a similar industry. Ask them who they use. Also look for independent sources like Trustpilot, for example. That's always a great one. But don't forget to interview or talk to a few accountants and compare not only price, of course, but also compare their communication styles and how you think you will relate to them. It is ideally a long-term working relationship. They will help you grow your business. So it's important that, you know, you get on with them and that you respect them. And crucially, that you feel that you can ask them questions, especially if finance is not a strong area for you. You have to be able to feel that you can ask questions and get answers that you understand. Okay, Joanne, that is the end of my slides.
Just one more question there, Larissa, if you don't mind.
Sure.
So can your company have an investment account to invest spare cash that can grow and later be used to fund your salary in the future?
Yes, so that's a great question. And I kind of mentioned earlier on, whenever I said, if you have spare cash and you're growing the business, a pension may not be a good idea. But what I didn't say was, if you do have spare cash and you are looking to grow your business, but maybe not right now, but you know, maybe grow the business in the future, or as this question has asked, whether to pay future salaries. Yes, you can absolutely get a corporate savings account. Yes. And there's various different, you know, accounts on the market. And actually, we do a monthly webinar with the Ask Paul team, and they do offer corporate savings accounts, and we can absolutely put you in touch with those guys, or you can join the next webinar. I'm not too sure when that is, Joanne.
I'm not too sure on that, the next one for that. But if you go onto our website and if you go into resources, you can find, or you can join up to our newsletter and find out about all our upcoming webinars. I will also ask if you have found this webinar helpful. You know, your feedback is important to us. So if you would like to share a review for this would be really helpful. Just also to discuss another upcoming webinar that we have as well, just to discuss the importance of bookkeeping and using that on a software. Justin McCreevy hosts that webinar, and how an introduction to cloud accountancy software. So I'm going to pop the link in there for that if you're interested in joining that as well. But thank you, Larissa, for sharing all your expertise today, and thank you everyone for your participation.